Okay, well, as the numbers are starting to increase, I will start the introductions. First and foremost, thank you to everyone who's joining us for this final session of ESG online. It's green financing, looking at commodity trading through the investor's lens. And we're joined by some fabulous panelists who will introduce themselves in just a moment. Just a bit of housekeeping from us. We obviously would encourage questions, but if you could please direct them through the Q&A box rather than the chat, that would be amazing. And if you have missed the first few seconds or want to watch this session back or any of the other sessions, you'll be receiving an email in the next 24 hours with access to all of the recording of the session. So that being said, I'm going to hand over to Carter Hoffman, who is the moderator for today's session. And yeah, have a great session, guys. Thank you.
Awesome, thank you. Hello everyone, my name is Carter Hoffman. So I'm assistant editor at Trade Finance Global. So it's no secret that the commodities industry as a whole has a massive role to play in our world's sustainable transition. But the financial sector also has a key role to play, kind of from the commodity side, especially since financiers are able to pass on some of their green obligations to other stakeholders. Now this helps align some of the economic and environmental incentives throughout the commodity trading market. So for this panel session, I'm joined by Sebastien, co-founder and director of Climate Neutral Commodity, Maryana Stober, president of Wista Switzerland and associate general counsel EMEA at ADM, and Swaroop NLN, director of alternate distribution and sustainable trade finance at HSBC. So welcome to the panel, everyone. So I think we can just kick things off with a quick round of introductions. So in no more than 30 seconds, who are you, where are you from, what do you do? Paul, why don't we start with you?
Yes, thank you, Carter. So very pleased to be with you today. So I'm a former commodity energy and carbon trader in banks, in hedge funds before, and then I left the screens of the market to accompany energy transition programs for national agencies in Africa and for the and as I acted as a commodity slash sustainability expert to the UN. And 2 years ago, I co-founded a Climate Neutral Committee, which is a certification standard for carbon neutral commodity transactions and services.
Awesome, thank you. Swaroop?
Hello, everyone. My name is Swaroop. I'm a part of HSBC's trade finance team, and I look at sustainability in trade finance, innovation and partnerships area. In addition, I'm also looking at distribution of our assets to institutional investors. So this topic is quite relevant because I see both the sides on how bank financiers like banks look at sustainability in trade finance, and also how investors who are trying to invest in this asset class or bring more capital to trade finance look at this asset class from an ESG investing perspective.
Thank you. And Maryana?
Hello, everyone. My name is Maryana Stober, and I'm a lawyer by background. I work for ADM, Archer Daniels Midland, and I work very closely with our sustainability team and advise them on various sustainability disclosures. And as my hobby, I'm also president of an NGO, which is called Wista, Women in Shipping and Trading Association. So that's an NGO which is promoting women leadership in trading and shipping industries. Happy to be here. Thank you.
Awesome, thank you. So now before we dive into some of the details, I kind of want to start things off from more of a high level. So now, especially when it comes to sustainability and the ESG agenda today, there's definitely a lot of buzzwords and phrases that can be thrown around, and that certainly at times can create a bit of uncertainty and confusion about what we're actually talking about. So Maryana, I'm hoping you can help us clear some of this up right off the bat. What exactly is green financing and why is it important?
Yeah, sure. When I was preparing for today's conference or seminar, I actually started thinking about it myself. And I think it's a very good question. And there are two ways looking at it. If you would say, you can say that the narrow look at the green financing would be financing in projects or transactions which have a positive environmental impact or climate change impact or emissions, reducing emissions or fighting global warming, or making an impact in fighting global warming. while the other way of looking at it is just wider. So the whole ESG, so ESG stands for environment, social, and governance. So green financing, you can say the wide definition would be investments in the projects or transactions which have positive ESG component. So not only environmental side, but also social side, and also good corporate governance. That's my way of looking at it.
All right. So Swaroop, over to you. When it comes to green financing, what kinds of things are financiers looking for in companies?
It's a very interesting area, right? I mean, from an evolution perspective at HSBC, we have actually been associated with this space from quite early days. And I tend to agree with Maryana that it's not just the green aspect of it, but the holistic ESG space that we need to look at, because these are hugely interrelated. And you can't ignore one while solving for the other, because you can't create another problem while solving one. But from a green financing perspective, what we have seen, and I'll cover this in two parts on what the evolution has been and what investors are looking for. From an evolution standpoint, this started the green financing and green focus with large consumer-facing sectors looking at sustainability areas and implementing sustainable practices in their businesses and their supply chains. That's where most of the companies and big corporations started, because of the customer focus and customer activism. It moved towards the ecosystem, the buyer-supplier ecosystem of those anchors, and that's when they started asking for ESG and green facilities and green financing. So led by renewables and green energy and renewable energy sort of areas. This then moved to development of new products and propositions. Of course, the bond market, which started first, is now moved into other transaction banking and other lending areas. So that's the third piece. And then moving further into the holistic ESG sort of solutions, where it's not just financiers, but the whole ecosystem coming together of financiers, multilaterals, other partners, ecosystem players coming together. So that's sort of the various elements of the ESG journey that we have seen over the last few years. And in terms of what investors are looking at, so this is very much an evolving market even today. So we are constantly developing new solutions, new partnerships and innovations. What investors are now looking at in this evolution, because it has been so a process which has happened by way of how market demand has moved, there has been no standardization. So the biggest point that investors and people investing and putting capital in sustainability is, where is the standardization, what is the definition, and where is the data? These are the biggest questions that come out when you talk about green financing opportunities across investor base, particularly in the institutional investor space. And some of it is getting standardized, but there's a long distance to go. Of course, markets which started early, like the bond market, etc., are slightly ahead, whereas others, the loan market and other pieces, are now evolving in terms of standardizing these areas. So investors are clearly looking for that. The other piece that people are looking at is access to information across the life cycle. So it's not just the green and the end use piece, it is the other areas of ESG or how reporting happens. For instance, in case of commodities, it's not just sufficient to talk about carbon or energy. It is important to talk about the overall impact of commodity cycle. For example, commodities are one of the largest contributors to land use and deforestation cases. We all know this. There's a lot of publication around it. So how does that data get reported? Just a couple of days back, TNFD came out with a report on reporting nature-related financial disclosures, and how do we report deforestation-related financial disclosures. So those are the areas which will actually lead investors to invest more confidently and invest more directed capital in areas which can have impact. Because ultimately, out of all this, investors are looking for impact investing, and that impact has to be evidenced by way of data.
Thank you. So then in terms of, having that evidence, having a verifiable way that investors can trust that these companies are actually green and may not be, hiding some brown and gray stuff underneath the surface. Paul, what are some of the ways that companies actually verify this?
Thank you, Carter. So I totally agree with what Maryana and Swaroop said, and to bounce back on what Swaroop highlighted, I think in the notion of green finance is pretty complex, and there are different notions those notions are complex and diverse, and when you deal with green finance, you may understand to finance projects and businesses that are intrinsically green, or businesses that are supporting a transition to a green economy. So at first, it's something that the boundaries of what is green and what is carbon neutral, climate neutral, or ESG compliant has to be clearly defined. Only for the environmental perspective, those notions are diverse, and the risk of criticism and the risk of backlashes for companies that are misusing those notions may be as diverse as those notions. For instance, to define what is green, it means first to define the carbon neutrality, to define some standards to measure to define the carbon footprint. Sorry, to define how to measure, how to report those carbon footprint. So there are now various standards in the markets with the ESG protocol, ISO 14064, and so on. So there are these kind of standards, and then it implies for companies to understand how to mitigate this carbon footprint, or how to accompany the industry in the carbon reduction journey. And that's far more complex because there is no single consensus on what is green, or what is taking part to the reduction journey. So now the fact of the industry, and Swaroop, Maryana, correct me if I'm wrong, I think it's a learning by doing phase for the whole industry. And as Swaroop said, there is definitely a need for standardization, because now companies are statement of companies are based on self-declaration, and self-declaration is so it may lead to criticism and backlashes for even greenwashing, or at least for over-claiming some ESG achievements. You may have read last week in the press that Goldman Sachs, there is an investigation in Goldman Sachs for their ESG strategy and ESG compliant portfolio. So I don't know the fundamental, the rationale of this investigation, but it means that the risk of misusing, and I don't know if that was the case, but I mean that the risk for companies, for financiers, is crucial it's a crucial point for companies to avoid this risk of backlashes with third-party verification, with clear standards, with with clarity, in order to facilitate the decision-making process for those companies, and to avoid any risk of backlash.
Awesome, thank you. So in terms of avoiding backlashes, obviously that requires them to, start down the green process in the first place. So where does some of that motivation come from for companies to invest in, say, green projects rather than ones that might not be green but might be able to make a little bit more return than those that are?
Yeah, I think Swaroop well highlighted this point, that it's known that the commodity industry is by far the first contributor to greenhouse gases, 20%, 25% of the global greenhouse gases are due to land use and agriculture. I think that's around 7% for mining, 3% for maritime and shipping. So it's by far the main contributor. So that's the first thing. Now, the second point to contextualize is that 80% of the global GDP is committed to net zero. So it would mean, with all the disclaimer, if the world is going to make it, and we may have some doubt on it, but anyway, it would mean that 50% of the 80% of the GDP, so 40% of the global emissions, should be erased by the end of the decade. So it's massive, it's huge. So that's the context. Based on this, for a company to be net zero and to be climate neutral, it means that they measure, report, and mitigate their emissions, their direct emissions, but also their indirect emissions, their scope 3, what we call the scope 3. So for a commodity buyer, for a commodity, for a car maker or a battery maker, it means to cover the emissions related to the minerals, metals they get. For an agro industry company, it means to report and mitigate the environmental footprint of the agro commodities they use. So now there is a demand from those companies for green or low carbon commodity supply chains. So first, for financiers or for any commodity industry stakeholders, there are business opportunities based on the demand of the end buyers of this industry. So for financiers to finance this industry is also to finance a growing market for green commodities. Of course, there's a second point that and Swaroop may correct me if I'm wrong, but the carbon footprint of those portfolio and transactions are also a part of the scope 3 of those banks. So banks are currently juggling between the business as usual financing the industry and their own ESG objective and their own ESG strategy. So to finance low carbon or activity, it's a way to reduce the scope 3 of the bank itself and to achieve the objective of the bank. And third, the point which is quite important, that energy transition, the budget required for energy transition, globally speaking, is estimated to be about $120 trillion by 2050. So $4 trillion per year by 2050. So it represents the equivalent GDP of France and Spain per year that has to be invested in energy transition infrastructure. So it's a massive, it's huge. And so for financiers, it's energy transition are also business opportunities that they cannot miss. So it's let's say that to sum up, for financiers to finance green projects or to be involved in the energy transition financing world is first to achieve their own objective, is to gain business opportunities from the industry stakeholders, but it's also a way to have a step in the green financing world that are assessed to be on trillion and trillion of dollars. So it's opportunities that they cannot miss.
Awesome, thank you. So I want to switch gears a little bit here and kind of talk about some of the regulations that are in place. Now, we do have a poll for the audience right now. If we can get that up on the screen, please. Awesome. So do you think that the ESG space is appropriately regulated at the moment? So then kind of while we wait for those responses to come in, Maryana, can you kind of walk us through what are some of the ESG requirements and maybe how do they differ between firms, financiers, and governments?
Yeah, sure. And I will focus first of all on Europe, wider Europe, because that's where we are located. I think all of the panelists are located, and that's what I know most. So first, regulations in Europe started to appear around the human rights. And this was the Modern Day Slavery Act and the legislation in France, Germany, and the Netherlands. And this is specific legislation that requires companies, mostly bigger companies, and smaller companies are not really caught by it, to learn their supply chains, to invest in due diligence in their supply chains, understand risks, and actually manage these risks. And until now, until recently, the real legislation that required companies to do due diligence and report was actually really around human rights. all the reporting that companies have done around the environmental goals and achieving these goals and milestones, KPIs, and the projects around these goals, this was just voluntary. And as Paul has correctly mentioned, it was everybody was doing a little bit what they can, what they think is the best way of achieving these goals, and so on. And now what I see is a big change in the legal framework that is coming up in the next few years, where we actually will see exact legislation that will regulate disclosures and due diligence also in other areas of ESG, not only human rights, but also environment. And we see first Swiss legislation coming up in 2023, which will require companies to do due diligence and disclose risks and steps they're taking in their supply chains to manage human rights risks and also environmental risks and corruption risks. And this legislation, which is already adopted and which will come in force in 2023, as I have said. And then there is but this is just Switzerland, and it will not catch that many companies or bigger majority of companies active in Europe. But now we have, since earlier beginning of this year, we have very important EU draft directive that is now being put on the public discussion, and it's called the EU draft directive on the corporate sustainability due diligence. And that directive, and I believe it will be adopted maybe later this year or next year, it will actually apply to bigger and medium-sized companies in the EU, not to the smaller companies, but still it will apply to the human rights and also to the environmental goals that companies are putting. And it will require companies to disclose their due diligence efforts, their risks, and what they are doing to mitigate these risks. And it will also require companies to report on their environmental strategy, what they are doing in order to achieve the limits set by the Paris Agreement. So I think that will bring a big change on the market, because it will set a framework that will apply to all companies in the EU, how to disclose their environmental goals. And each member state will have the right to implement it. Maybe there will be some differences in different countries. There will be also liability connected to it. So there will be a stricter possibility of enforcement. So overall, I think it's a very positive change coming, and it's actually needed change. I think companies will really appreciate it, because when you have a real framework and understandable, clear framework, then it's also easier to operate as a company. And I think it's also easier for finance institutions, for banks to evaluate various projects and evaluate customers. And last but not least, we have a very important legislation in the US that is upcoming, and also draft from the Securities Exchange Commission that will apply to the public companies and the funds, and that will hopefully just draft that was put on discussion, I think in May, but that will also set standards how companies should regulate their ESG goals and their ESG disclosures. And I think when we will have, hopefully in 1 year, that's my personal estimate, when we will have these two legislations in the EU and the US, that will be actually great, because that will set a very good standard where companies globally will be able to look up to and to operate.
Thank you. I believe we should be able to get the answers from that poll up on the screen now. So interesting there, 70% of people believe that the ESG space is not appropriately regulated at the moment. So Maryana, does that surprise you at all, that so many people say it's not?
It doesn't surprise me at all. That's what I think myself as well, very much. I'm in that part of the people that voted no. I think that's the right answer. But hopefully, like in 2 years' time, we will have the answer yes, when we will have this European and US legislations adopted.
Right. So Swaroop, let me come to you. So when it comes to implementing regulation, so of course, we just saw 70% of people don't think it's regulated properly at the moment. How can lawmakers kind of strike that balance between creating regulations that are too strict and regulations that might not be strict enough?
So, I think strict is not the right word in my view. I think it has to be practical and impactful. And in the ESG space, I was just yesterday at the London Climate Action Week as well, and we were discussing that we cannot wait for perfection in this whole issue, because this is such a transient and evolving subject that we cannot wait for perfection. And I kind of compare ESG risk as a big pillar like credit risks. So all of us have seen that over the years, credit risk has been very robustly regulated. There are mechanisms. There is a huge amount of consistency across institutions, markets, companies on how they manage credit risk. We all need to, as countries, institutions, begin you start looking at ESG risk also in a consistent manner. And I'll give you 2-3 examples, right? If you look at ESG ratings across, and there are many players. I will not name a single anyone. I will not single out anyone, but the methodology itself is not consistent, very compared to credit ratings, and this differential is actually could create trouble. So we need to have consistency in methodologies. There are regulatory interventions which have also happened sporadically. So Maryana covered a few regulations. In fact, in EU, I think one of the other pieces that is coming and is very big is the carbon border adjustment mechanism, which will actually regulate a lot of imports and see how carbon there'll be carbon cost for imports into the EU region from rest of the world. So there'll be a lot of new regulations and differentials created in different parts of the world which need convergence. So I think what is needed is to be able to bring convergence in many of these methodologies. We need to have consistent methodologies in rating, measurement, and disclosure. And part of the effort at GFANS or TCFD or TNFD is that to bring these methodologies together and have consistency. And that's how we will be able to solve the problem progressively. The other key piece that we need to keep in mind is none of us know these risks really well, because these are all forward-looking risks, and we have always been used to backward-looking approaches when we were managing risks. So forward-looking approach on risk management in ESG is going to be key in solving the issues, and therefore we need to take a bit of a bold action to see the impact. And finally, I think what is also important is to be able to see from a practitioner's point of view on what is practically possible. And if you see the example of NGFS, Network of Greening Financial System of Supervisors in central banks, which is now doing consultation around climate risk testing, they have actually taken a very practical approach on how supervisors could actually come up with models which can help direct climate risk and stress testing in future. So regulators and supervisors need to take practical medium-term view of the issue while keeping in mind the long-term impact. So if I have to summarize, don't wait for perfection, convergence, and take a medium and long-term view together to be able to solve this issue practically.
Thank you. So one of the things that I've heard come up kind of multiple times throughout this conversation has been the need for consistency, the need for standardization, these sorts of things. So Paul, when it comes to standardizing ESG indicators and metrics across the EU or even across the world, like what would some of the benefits of this be?
Yeah, I think I'm going to bounce back on what Swaroop said. I think among the key words is a consistency, standardizations, clarity. Let's say. I think I'm back on the example of that the energy transition will require $123 trillion by 2050. So for decision maker to commit such amount of money, that requires clarity on the rules, on the standards that are going to be that are recognized now, but that will be also recognized in 1 to 5 years from now. So to have a clarity on those rules, on those standards, and to be sure that the rules are not going to change in few years is a key point. It's very difficult now for decision makers to understand what will be the the roadmap, what will be the jurisdictional framework in few years from now. So this lack of clarity is also a constraint for financiers to commit and to make any choice. The second point is that this lack of standardization that we see now is a key point for risk manager in banks and in any company, because without any clear standards, there is the risk of the reputational risk and to be backlash. Okay, if there is any miscommunication on the achievement, but there is also the financial risk. Financial risk, it means the risk to face fines in case of change in regulation, in case of any investigation from a NGO, public or regulator, but also the financial risk on the risk to not accessing funding in the appropriate manner. I'm going to give you an example of a national company that contacted me months ago, because they had to finance for several billion of dollars of assets in 2022. So that was more than six months ago. And they asked their usual banks, okay, we need to refinance for several billions of assets. And their usual financer told them, now you have to, there's no open bar anymore. If you want if you want funding, you need to prove your achievement in initiating, starting a decarbonization journey. And they didn't know how to start it because they were maybe pretty far and not very advanced. But to define a roadmap, decarbonization roadmap, to comply with the query of their financiers was a pain, because even the question of their financer was not clear based on standards, and themselves they were in a fog, they were in a totally mess without knowing how to start it, and to be sure that if they commit the whole group in such a strategy, that it will be relevant in few years from now. So I think that the industry definitely needs standards, not as a constraint for the industry, but in order to support decision makers with a clear framework and with confidence on what will be the framework in the coming years.
Thank you. So you mentioned a lot in terms of frameworks and having a roadmap, and that these are some of the things that we would need to achieve a lot of the standardization. So Maryana, let me ask you, is this level of standardization possible in the world? You know, if it is, on top of, or like what would go into these frameworks and roadmaps to make it possible, and who should really own that process to kind of drive it forward?
Yeah. First, I would like to say I completely agree with Paul that I wanted to say what I agree with. Well, you made a good point. I completely forgot which one I wanted to align with. Yeah, coming back to standardization, I think that the level of standardization or some kind of having few frameworks in the world is completely possible, because we are already looking towards the EU legislation, and we are looking towards a new draft of the legislation in the US. And normally these are two legal systems that are setting the standard, and we have seen it with the GDPR, for example, and we have seen it in other situations, but I would say GDPR is a very bright example. So I think once EU will set up its standard and the US will set up its standard, other countries that even are not members of the EU, but still want to operate in this space or in the US, they will be, if you wish, forced, or they will be inclined, or they will be advised to follow these standards. So I think once the bigger players in the market will set up the standard, the rest will follow. So I think we are really looking towards some unified standard maybe next year. And in my view, this will be really positive. As Swaroop said, nothing is perfect. Maybe this standard will not be really perfect. Maybe it will need to be changed in 5 or 10 years. But I think this is a very good start. And what business wants to have clarity and predictability. And these two pieces of legislation, I think, will actually, or are supposed to provide that.
If I may add also on what Maryana said, that a couple of years ago, so it's pretty fresh, the industry and industry stakeholders, traders and so on, we are not looking for this kind of standards, for this kind of regulation, because they thought that I'm a former trader, so I can, at least for my part, they thought that any kind of standardization like that would be a constraint. And now there has been a paradigm shift. Traders and industry stakeholders, they are looking for this kind of standardization. So because they see that it's for their own interest, it's to mitigate those risks, but also to have a clear assessment roadmap of business opportunities, and so that also standards may create business opportunities. So it's important to understand this paradigm shift that we have seen in the past year, in the past 2 years.
Right, and I assume that shift is kind of driving the transition forward and probably accelerating a lot of the desire from other stakeholders to kind of reduces a lot of the friction that's going into, or that would have gone into preventing standardization or holding it back. So we only have a couple minutes left. I want to ask Swaroop one more question before we hop over and get some questions from the audience. So kind of bringing it all full circle, we've talked about financing, we've talked about regulations, we've talked about standardization. So Swaroop, what would a successful model of financing look like, and what's really needed for us to drive the change necessary to implement it?
I'll try to make it quick in order to give more time for questions. But if I touched upon this in the beginning, right? Any form of investment the traditional model was to look at it from a risk-reward perspective. I think the third pillar that has got added very clearly is the impact piece. So it's the risk, reward, and impact area. And with that lens, we need to look at it from a financing point of view, from a holistic end-to-end perspective. So for instance, in this case of commodities, we need to look at the ESG risks across the life cycle. So when I say across the life cycle, it is the sourcing, which is your physical origins and location sort of risks, the supply chain risks, supply chain related land use and other risks, usage, products and services, and finally the carbon footprint and on the overall life cycle. So it's this holistic lens of ESG which makes the impact together. You can't have, not to say that you can't address one over the other, but you need to look at the risk holistically to be able to make progress. You can't solve for one without having a view on the other. And then finally, this has to be supplemented with data. If we get these three things right, we can then have more capital unlocked into this area, which could be a combination of financial firms, multilaterals, private wealth, etc., which is waiting to come into ESG investments. And it's, I think the single biggest constraint is the transparency and data, which they're missing, because what can be measured can attract more capital. So it's very clear that if we can actually have this holistic end-to-end view on ESG risks, have the data and unlock, and it's possible to do this in pockets. So it's not easy to solve it, but there are pockets where you can do this even today. And we are trying at HSBC to initiate some of those policies and build on what is available in the market. For example, build on supply chains in carbon reduction, build on building diversity and inclusion parameters across carbon reduction in the value chains, get institutional capital. We are working with multilaterals to bring them in as partners to have impact in deeper layers of supply chains, etc. So it is possible to take incremental steps, and as the regulation and convergence happens on these standards, we will have greater flow moving in this direction. So we all need to take collective action, contribute to this debate, and keep making progress, because the problem is only increasing every day we stall and not move forward.
Awesome, thank you. So it leaves us with a little bit less than 5 minutes left here to get some questions from the audience. So I'll read out the one here from Matthew. So how do you see the role of data providers who can supply estimates of emissions for individual facilities according to standardized methodology versus data coming directly from the supplier?
Sorry, the question is on the relevance of a service provider and data provider. I don't read the question. I don't see the question. I think that the role of a service provider is crucial. Now all those processes are complex. Again, decision makers have their daily job. They're involved in their daily job on how to run their business. All those notions on ESG and not only on environment and carbon footprint calculation and so on are pretty complex. So there is a room and there's a role to play for specialists, experts in this doing to support decision makers. Now the question is how to support those companies, but how to access relevant data. And I think that was Swaroop, we mentioned that previously, that the data are not always easy to access, especially in a fragmented supply chain. And so, and even when they could be accessible, sometimes they do not exist. So it's important to deal with some emission factors, with some estimates, let's say, and the risk of error always remain, and it's important that these risks is managed by experts, and so it's also the role of experts and third-party experts to externalize this risk with clear methodologies and when not standards, but at least methodologies on how they handle data and respond to the industry needs. So I think that everything cannot be done by internal experts, and the role of a specialist in this on those topics are crucial. I don't know if that.
Yeah, I think this is the area where supervisors and regulators also have a role to play, right, in disclosures. I think in the intervening period, when we have voluntary plus these data providers coming in, as has been alluded to in the question, we will have this challenge. But I think these are the areas where supervisory and regulatory policy intervention is required on the type of disclosure and the level of disclosure that is going to happen. And I think we are making progress in that direction. We already are seeing regulatory discourse in this area, and that day is not, and it's not far that we will have clear regulations on minimum standards for disclosure, which will actually help standardize.
Awesome. Maryana, anything you want to add to that?
Yeah, I completely agree. First and second, I think we just need to wait maybe a couple of years, like with GDPR, when we got first legal cases, first fines, which have set up a standard which help now companies to understand what is the standard they have to strive for. Unfortunately, with the environment and the climate change, we don't want to have that many years to wait for these court cases. We should have these rules sooner than later.
Awesome. So I think we only have about a minute left. So I want to just give all the panelists one last chance to kind of share a final thought here. So very quickly, what would you guys say is the single most important thing that the industry needs to do to successfully make the green transition? So Paul, let's start with you.
I would just say that I think that the industry need to understand that energy transition and a green agenda is not a constraint, but it's raising business opportunities. And so when there are business opportunities, there's interest to accelerate in this direction.
Swaroop?
I think it's embracing this challenge and opportunity and looking at it in a holistic manner, and not just an isolated way of looking at either carbon or looking at energy. Looking at the ESG challenge as a holistic end-to-end challenge, particularly in the commodity space, when they have such a profound impact across the value chain and across the risks spectrum, be it climate, forestry, land use, and other areas. So it's nature, biodiversity. I didn't even touch upon that. So it's the end-to-end holistic view that we all need to take around ESG in commodities.
And Maryana?
Yeah, I think it's very simple. We just need to do the transition because it needs to be done, and the sooner the better. Yeah, thank you very much.
Awesome. Yeah, thank you everybody for all your ideas. It was a really great discussion. I believe I'll hand it back over to Marie now to say a couple words.
Yes, thanks a lot, Carter, and thanks, Maryana, Paul, and Swaroop, for this very interesting discussion. I just wanted to say, a few thank yous to all speakers involved in the last 2 days, and to thank all the viewers for being with us. It was, a great couple of days. I'd like to remind you that we are hosting the Energy Trading Week on the 28th, 29th of September, which will have a net zero track and much more. So we look forward to seeing you there then. All right, well, wish you all a nice afternoon or nice evening, depending on where you're based. And thanks a lot for being here. Thank you very much.